We're going to go through pricing the insurance component. This is in section 4.3 in your study notes if you are looking for some more information or additional details about the insurance component. I'm going to start off with what is NAR, N-A-A-R. That is really important with pricing and to understand how the cost of insurance works. So that NAR is the net amount at risk. That's what the acronym stands for. And it is the death benefit minus the investment account value. And what NAR actually is the insurance cost or the cost of the risk to the insurance company. So how much risk is the insurance company taking on in order to insure the life insured? Is it significant? Is it minimal? And the reason that we subtract the investment account value is because that value actually takes away from some of the risk, because that means that there is some investment there that can cover some of that risk. And so there are a couple things to remember about the pricing and NAR and how it affects the cost of insurance. So the higher the investment value, the lower the NAR. So like we were just talking about, the investment value does cover some of that risk. So if it's more, it's going to lower the risk that the insurance company is taking on. If the insurance risk that the company is taking on is lower, then the mortality charge is lower. So the amount that is being charged to the client as part of that cost of insurance is lower. And if the mortality charge is lower, so what the client is paying is lower, then there's more potential growth available in the investment account. So that means that the money that the payer is paying, let's say he's paying $50 and the mortality clause is $5 instead of $10, the rest of that money is going towards the investment account and allowing the policy to grow and, again, reduce the NAR. So this is sort of a cycle and a circle, and everything is connected in terms of how much is being paid, what the investment amount is, and how much risk the company is taking on. Now, there are two different types of mortality charges. It can either be YRT or LCOI. We're going to start off with YRT, which stands for the yearly renewable term. And the yearly renewable term is based on every $1,000 of insurance. And what's important to remember is that this is yearly or annual, so the amount or the charge is annual and it changes every single year. So it's very cheap in the early years because typically there's not a lot of risk being taken on, and it increases in price just like a term policy does. So every year or every few years it will increase in price, and so the policy does become more expensive. YRT lets the cash value increase quickly in the early years because, let's go back to that $50 example. If you're paying $50 for your policy and your YRT or your mortality charge is only $10, then the rest of that amount gets put into your investment account. Your investment account has an opportunity to grow much faster because there's more money being invested. However, the YRT does get more expensive over time. So let's say year 15 into your policy, your YRT is not going to be 10 anymore. It might be 20, it might be 30. And so the amount that you're investing into your policy is significantly less than it was in those early years. It's really important that your cash value has grown to be a significant amount or enough that it will cover this change in the YRT. This policy is risky because you're hoping that the cash value will increase quickly enough in order to cover that difference or to make up for the fact that your YRT is increasing. It is possible to switch from YRT to LCOI, which we will talk about in the next slide. But the cost is based on the age of the client at that time. So if your client does decide to switch from YRT and they got their policy when they were 20 and now they're 30, the switch, so the mortality charge for the LCOI is going to be based on their age at 30. So that is something that is really important to understand. Now, policies can either have a guaranteed increase or an adjustable increase. The guaranteed increase means the cost of insurance changes will be set in the policy. So basically the policyholder will know in advance what the changes or what the increases will be, and they are aware of them as long as they've read their policy. Adjustable means that they can change, but they are not aware of exactly how much they can change by. And there are two possibilities in adjustable. They can either be open-ended or restricted. Either way, those increases are not set in advance, and the COI increase can change. The restricted has a limit on the increase. So let's say, for example, it can't go above 20% of whatever the original schedule was in the contract. However, the open-ended adjustable has no limit, just like it sort of implies, and that means it can increase by any amount. So this adjustable change in the COI is extremely risky, and it's very, very important to make sure that your clients are aware of what situation they are in their contract. Last but not least, we're going to go through the LCOI, which is the level cost of insurance based on a T100 policy. So remember, a T100 policy is a permanent policy that does not have any cash value in it. The cost per 100,000 remains constant over the policy, so it does not ever change, very different to the yearly renewable term, which changes every year. Now, this is more expensive in the early years because there's no potential increase coming. With YRT, the insurance company knows, well, in 50 years, I might start off with 10 now, but in 50 years, I might end up with $30 or $40 or $50 from this client. With LCOI, you are not going to end up with any more than what you started with. So, of course, your amount going in, the mortality cost, is more expensive. And so instead of getting a $10 YRT, with the LCOI, you might end up at $20 or $25 of that $50 that you're paying in premiums. So it is more expensive in the early years. However, it is safer because you know that the prices will not change. If you're paying that, you're always paying that. You don't have to worry about what's happening in that investment account, because regardless of what's happening in the investment account, you're always paying the same amount because you have a guaranteed level cost of insurance. Now, these policies are less likely to lapse. There are some other details about lapsing that are in your study notes, and we will review in another video. But it is important to know that these can possibly lapse as well, but it's very, very unlikely, far less likely than with a yearly renewable term. If you would like some more information or really want to dive into this topic a little bit more, please check out your study notes, section 4.3.